Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Caleb Frankert, and I'm joined by my good friend and fellow money muddler, Jason Burnell.
Caleb, can a podcast about finance be entertaining?
Not without alcohol.
All right, let's mix it up.
Woo. Let's.
We already mixed it, though.
We did.
Yeah.
2 days again. We've done this a few times. Works out better. The second one's always more fun.
That's right. For some reason.
Yeah. I mean, it's got to be fun. We're talking about the Fed today.
Oh, my favorite topic.
Yeah.
Yes.
And we have a new cocktail to try.
Yeah.
I had never heard of this. Never heard of it. And
it looks good, though. All the ingredients we are big fans of.
Yeah, there's a lot of ingredients. This actually, okay, I'm going to just say this. We have not tried it yet, but it kind of reminds me of a Long Island iced tea.
It does.
But not trashy. If you enjoy a Long Island iced tea, God bless you. Enjoy, okay? But yeah, this has just got all kinds of stuff in it. But you know what? You know what else has a lot of stuff in it? This episode.
Oh, right. Whoa. Quack, quack.
Yeah, we're going to talk about the Fed because we hear a lot about the Fed these days,
Yeah.
right? So what exactly do they do? What does it mean when we talk about interest rate hikes and people freaking out?
Why does it matter?
Why does it matter? How does it honestly impact everyday folks? We are definitely not diving into all the details and intricacies of everything the Fed does and all the ways that it trickles down into the system and how it eventually hits your wallet.
Yeah, download our ebook for that. Oh, wait, we don't.
I'll put it in the show notes. Yeah, so this is going to be more of a primer.
Yeah.
But you know what? If you are sitting at the bar with your friend or at a speakeasy, let's say, and you're sipping on a cocktail and, you know, the interest rate Fed topic comes up, you will be able to hang.
That's right.
In a conversation with your friends after this episode, I hope. All that being said,
yes,
let's get into the drink. This is a high horse, Jason. Yes. A high horse, which to me, I hear high horse and I think immediately Kentucky. This is going to be a bourbon heavy drink. Nope.
Nope.
No bourbon.
A little bit.
So let's get into the ingredients.
I thought the first thing I thought was get off your high horse.
Okay.
Yeah.
But
I know.
No idea what kind of drink. Yeah.
No.
I don't know why they call it a high horse. I probably could read the drink history, but we don't get into that as much these days.
No, we're just getting right down to business.
So let's get into the ingredients here and the high horse. We start with 1.5 ounces of aged rum or spiced rum, however, you know what? Dark rum of your choice. Put it that way.
Yep.
A 1/2 ounce of brandy. And if you have cognac sitting around, cognac is a brandy.
Very similar.
1/2 ounce of cherry liqueur. So don't make the mistake and use Luxardo, because even though Luxardo makes those awesome cherries that we love, it's not really a cherry liqueur.
Right.
We're talking like this is the most Long Island iced tea ingredient there is. I think we use Dr. McGillicuddy. It looks like medicine.
Right.
You know, those just obviously
I mean, the label is even like medicine.
So the cherry liqueur, 1/2 ounce of sweet vermouth. You know that we really like Carpano Antica. However, we're out, dang it. So we used Martini and Rossi, probably the most popular one out there, or the most readily available at least. 2 dashes of Angostura bitters. So basically add all the ingredients into a mixing glass or a shaker and shake, mix, whatever, get it real cold. And then you're going to garnish that with a brandied cherry. So Luxardo cherry.
Yep,
absolutely. Yeah, this one's interesting. It looks amazing.
It does.
It looks really, really cool.
It looks similar to Martini, or not a Martini.
A Manhattan?
A Manhattan,
yeah. Very similar to a Manhattan. Let's see what it tastes like, Jason.
I don't think it's going to taste like a Manhattan.
No. Cheers and dive right in.
All right. Oh, man. I like that a lot.
Ooh.
It's spicy.
Yeah, there is some spice. Well, it's the spiced rum.
Yeah.
Now, okay. You said it looks like a Manhattan, doesn't taste like it is similar to a Manhattan.
It is surprisingly similar to a Manhattan.
I use rye almost exclusively in Manhattans, and the spice the spice is making me think of a Manhattan. I mean, also get that cherry liqueur.
It's like almost like clovey cinnamon coming out.
Bingo. There it is. It's clovey. That's what it was. Thank you.
Heck?
It's clovey. This would be a good fall drink.
Where did that come from?
Yeah, that's good. I like that. And you know what? If you got a sweet tooth, it's sweet enough.
Oh, it's sweet.
It's sweet enough.
But
It's not cloying. It's not overpowering.
I mean, but let's face it. Look at the ingredients. There's a lot of
brandy's sweet. Yeah. Rum is sweeter. The cherry liqueur, I'm tasting that, and the vermouth in there. The Angostura bitters, that balances it real nice.
Yeah. Wow.
Nicely. Yeah.
I like really surprised.
I'm
on my high horse.
when I first found this, I thought, okay, this sounds cool, but it's probably going to be disappointing. Like I wouldn't be surprised if somebody threw absinthe in this one. You know what I mean? It kind of reminds me a little bit of the brandy cocktail that we did way back. I don't know how many episodes that was ago, but it's but yeah, that clovey spice. I don't know if that's the Angostura bitters or the spiced rum or just the combination.
Somebody was brilliant that mixed all because I don't know how you would have gotten to this point. You know what I mean?
Yeah.
Like a lot of other drinks, you can say, okay, that's a rendition of the Manhattan, or a margarita.
This might have been a happy accident,
right?
Like
it could have been
cleaning out the liquor cabinet or something.
We have to get rid of this cherry liqueur. What are we going to do with it?
Which was my theory when we did the Long Island iced tea episode. That it's just like get a garbage can, fill it up, so dump whatever you can find in it.
We did that way at a company party not that long ago.
Yeah,
that was a good time.
It was. A little bit of grapefruit juice goes a long way.
That's right.
This is very good. So a lot of times when we do this, I think to myself, okay, this is one to take home and try out, with the wife, see what she thinks. I think she's going to be on board with this one.
I like this one a lot. Sweet.
It's good.
Add that one to the recipe book.
Yeah, I think it's a crowd pleaser, man. If you like Manhattans, you like that spiciness, great. But if you got a little bit of a sweet tooth, I think it checks the boxes. This is good. And I think if you put this with nicer rum than what we had in the cabinet, if you mix this with a little bit nicer cherry liqueur and better brandy, better vermouth.
I wonder what cognac would do in here.
Can you imagine if you just used top shelf stuff and all these? Like this could be fantastic.
We did not use top shelf.
We did not.
I mean, we used Costco spiced rum.
Yeah.
Let's admit it.
It had, XO, right?
Yeah, I mean.
Or wait, was that the cognac?
No, that was a cognac. Yeah, it doesn't matter. It's not my. I like spiced rum a lot. Yeah. I mean, and I haven't drank it.
This is the second episode that we've recorded today, so
I haven't touched that bottle in a while.
Moving on. We better. All right, so today we're going to talk about the Fed, and a lot of people, they recognize the Fed. They recognize when people talk about the Fed, they might even know a little bit about what they do. But let's start with the nuts and bolts of this.
Sure.
The first thing we're going to get into, and really what we want to look at, is the impact of the Fed raising rates and what that means.
Right.
Again, we want you to be able to belly up to the bar with your friends, sip on a high horse, and keep up in the conversation, right?
Right. Well, it also will check the box in your head around okay, this starts to logically make sense.
Yes.
Why this is occurring and why it's such a big deal to the market, to the economy.
Yeah, all of the tentacles, right? That go out from the Fed and their decisions. This could tie a lot of the topics that we've covered over the last few weeks, months, whatever. It could tie a lot of that together, I think. So
sure.
Pretty timely. But again, this is, I think, a pretty evergreen episode too. So if you're listening to this 2 years down the road and you want to know who the Fed is, what they do, stay tuned.
Right.
I think you should learn something here. So let's get into that, Jason. We're going to talk about the Fed raising interest rates, but first, what does the Fed do? I wrote a couple things down. There are a lot of things they do, a lot of things that they're tasked with, whether they do it right or not. That's for a different discussion.
Another drink, and we'll have
another drink. Sure,
discussion.
The third podcast of the day, right?
Yeah.
Is the Fed doing a good job? All right.
Oh gosh.
So I think in general, a way to kind of summarize this would be it's their job or one of their aims, their mission to keep the economy going, not too hot,
right.
Not too cold.
Right.
But just right.
Just right.
Goldilocks. Right?
Yep.
Okay.
Yep.
So now, just knowing that, I think will help people to understand why there's so much conversation about raising rates, lowering rates, but we'll get into what all that
I think everyone, you'd have to be literally under a rock at this point to realize that, inflation is causing the economy to heat up really, really prices are there. I guess inflation is a result of the economy heating up so much demand. People are paying whatever it takes.
Yeah. So I think it's interesting that you say that, because a lot of times we hear inflation, we think, oh no, that's bad news. Well, okay, what it inherently means is the economy is too hot.
That's right.
Right? Things are heating up too fast.
Well, demand is higher than the supply. I mean, so people are going to pay more. It's simple economics.
Right. And you think that's a good thing, right? Things are growing. The economy is doing well, right? But inflation is a bad thing, right, Jason? Well, inflation is not inherently a bad thing. Hyperinflation is, inflation that's too high can be definitely.
Yeah, I think we've gotten dangerously close to the hyperinflation kind of number.
We could be.
Yeah.
We'll see where numbers come in, but the last rating was at like 9%. So that's historically high.
Very high, yes.
Now, we did the inflation episode, back in December at some point. So if you're wondering what we're talking about with inflation, go back and listen to that and how inflation impacts you. We'll get into some of the details.
So essentially what you're saying right now is that the porridge is too hot.
Yes. Well, there's debate on that one, Jason.
Well, I mean,
the Fed, the way that they're acting right now would signal to Americans that the economy is too hot right now.
Right.
So the Fed is tasked with managing monetary policy, essentially.
Correct.
And what that means is money supply, right?
Right.
So how much money is in bank accounts and in people's pockets, essentially.
Mm-hmm.
They're controlling the money supply with monetary policy. Okay, so when we talk about interest rates, okay, they don't directly change interest rates on your bank accounts or on loans or credit cards or anything like that. What they are changing, what policy they're affecting is something you've probably heard of called the Fed funds rate.
Yep.
Okay.
Yep.
So the Fed funds rate, essentially, you got to think of these big commercial banks that they have reserve requirements. They have to have so much money available for what's on deposit at their institution. So whenever there's shortages, they borrow from other banks, right? And there's a rate that they charge each other. That's the Fed funds rate, essentially. So the Federal Open Market Committee, aka the Fed, they set these target rates. Okay. Mm-hmm. All right. So I hope everybody's still with us there. Yes. We're not going to go too far into the weeds with that, but they're setting the interest rate on what big commercial banks are essentially charging each other to borrow money back and forth through the overnight lending rate. So
now this isn't one person making this decision.
No, there's regional Fed. There's they all vote, by the way.
Yeah.
So another term you may have heard is prime rate, right? This overnight lending rate affects prime rate. So if you go into the bank and you're looking for a loan, they're going to base everything off of prime rate, right? So
or some kind of rate standard like that. Yeah. That's usually impacted by the Fed funds rate.
Absolutely affected by the Fed funds rate. So if you are, a prime, well, I shouldn't say prime when I'm describing the prime rate. If you are a stellar, great credit score, a great borrower, let's say, you may get something closer to prime rate, right?
Mm-hmm.
Okay. So I think we've got that kind of settled.
It's less gray than it was.
How does that affect people? Okay. Well, first of all, we'll talk about, I guess before we get right into how does it affect people, why did they raise or lower rates? We've talked about it a little bit. They are trying to keep the economy Goldilocks.
Right.
Right? We don't want things to run too hot, even though that sounds crazy. Why would you on purpose slow down the economy, right? If the economy is doing well, that's a good thing. Well, okay. What can happen whenever the economy is doing really well is we end up with, things like inflation, which we've talked about, or asset bubbles, right? Maybe home values increase too quickly.
2007 and 2008, we definitely had a housing market bubble.
Or, when we talk about bubbles, and I think that with the stock market where people were worried, that we went up for so long that asset prices were overinflated. So where are the bubbles? I mean, look at Bitcoin and NFTs and things like that. Things you don't really understand when you're belly up to the bar drinking a high horse and your friends are talking about NFTs and you go, I don't know, this all sounds kind of crazy, right? It sounds like a bubble. So we're trying to prevent things like this, with monetary policy. So why would the Fed raise interest rates? Well, we don't want 9% inflation, meaning that the cost of goods are 9% more than they were last year. Did you get a 9% raise? Probably not. You're behind, right?
Yeah. So we're trying to prevent that persistent transitory inflation.
Don't even say that on my podcast.
That is just
strike that from
ridiculous.
The record. Don't even pay any attention. I'm not going to dignify that with a response. So
I should quote the person that said that, but it would be rude.
Don't. So, okay, realistically, the Fed is looking to combat inflation, right? And really, by raising these rates and things like that, they're trying to control the monetary supply. How much money is in bank reserves? How much money is in bank accounts, right? And they can, while they can't directly control this, they can certainly influence it by monetary policy or rate policy.
And this is wildly complex, guys. Like, this is not something that is just as simple as we're making it out to be. Because like through coronavirus time, we did a ton of stimulus. We sent checks directly to citizens and businesses.
We printed money.
They call that the M2 money supply. It is directly in folks' pockets. And the real stinker of this whole situation that we're currently in is they can't control that bucket of money.
So now they're tasked with interest rate policy to try to get a handle on printing 40% more money than was floating around.
That's already out in the economy. The bucket just got bigger. And so that's why this is like, when you keep hearing the term around a soft landing, right? And I just like get indigestion from something like that.
That's the high horse.
Yeah. It's just another way of them saying that this is really complex and is going to require, fragile movements.
Yeah.
And
it's a delicate situation.
And quite frankly, I think I said this yesterday, I have to give credit where credit is due. I'm shocked that the Fed has raised interest rates the way they have.
Yes. So here's another thing that you can throw around to your friends at the bar. They have been more hawkish than expected, right?
Yeah.
So their interest rate policy, hawkish versus dovish. Dovish would be gentle and, more easy money, whereas hawkish would be more aggressive,
absolutely
tight money, right? That's a great lead-in, I think, to let's talk practically speaking.
Exactly.
We kind of have an understanding of what the Fed does, why they set rate policy, how it affects the banks, and now we're going to get into how that affects you, and then the whole picture, right? So let's, we've talked conceptually, but let's talk about examples, right? So lending, right? Lending is dramatically affected by interest rate policy, okay? So when we're raising interest rates, what is the Fed essentially trying to do? They're trying to increase the cost of credit, right? We've had cheap money for a long time, right? It's been really beneficial for companies to go out and borrow money at historically low interest rates to turn around and invest in their company, invest in product lines, invest in employees, right? To create capital, those kinds of things. That is a low interest rate policy, is a high growth strategy, right? We want companies to go out and invest and spend their money because the money in the bank isn't paying anything. So spend, stimulate, invest, grow, right? So when we get to raising interest rates and we're increasing the cost of credit to companies and families, right? Higher interest rates mean that companies are going to invest less in their business, right?
Yeah, and this is simple mathematics. Like, if I go out and I invest or I buy a house for $250,000, that's way too low. $350,000, and now a year ago the payment was $750 less.
I know where you're going.
Yeah,
and instead of watching you do math in your head, let me give an example because I know exactly where you're going. I know exactly where you're going, and
you're prepared.
Yeah. I don't want to see the smoke come out of your ears. We'll actually do real math here. So we have an example. Yeah, so obviously businesses are going to be less likely to go borrow money and spend, right? Yeah. And we'll get into how this affects stock prices and things like that in a second. But let's talk about how a real practical example where you're going with the mortgage, okay? So let's look at how just a 1% interest rate increase in the Fed funds rate might affect, let's say, a mortgage loan, right? So let's say a family is buying a $300,000 house on a 30-year fixed rate mortgage. Interest rates of 3.5%. Let's see here. And by the way, I took this example from Forbes.com. Usually a pretty good resource, I think.
Sure.
The total lifetime cost of the mortgage would be approximately $485,000. Now, if you're listening to the podcast and you go, wait a second, $300,000 at 3.5%. How am I paying back $485,000? Keep digging. Okay.
Yeah, exactly.
Keep digging into that. All right. Those are good questions. So $185,000 of interest sounds like a lot, even though interest rates are low, right?
Right.
So your monthly payment on that principal and interest would be $1,340. Okay. So let's say this family decides that's an affordable mortgage payment. That looks good. By the time they find a house, Fed raised interest rates by 1%. There's an example that just happened, right? Fed raises rates by 1%. Same family looking at the same house at 4.5% over a 30-year span would look at paying back $547,000. Okay, so now $247,000 in interest. Mm-hmm. Monthly mortgage payment of $1,520 versus $1,340. There's an impact, right?
Right.
Are you more likely to go out and spend a bunch of money on a house, or are you more likely to say, you know what, this house has served us well. We're going to stick put. We're going to stay here with our 2.5% 10-year mortgage or whatever, right?
Exactly.
Right. So it's discouraging buying. Right.
Absolutely.
Which sounds crazy. Why would we want to do that? Okay. So there is a real life example of how that would work. I'll take thanks after the podcast for you not having to sit there and do the math in your head.
But the reality is there's still there's still folks out there competing for houses.
Mm-hmm.
It's going to slow it down, but it's not going to stop it.
Well, that's a good point, because I think what a lot of people are worried about is my home value is going to tank. No, it's not.
Right.
I mean, this is not a guarantee, okay? We don't make those here. What it's meant to do is to slow down the growth of home prices, which really, if you think about it, we've heard stories of, 20% over asking price, things like that, right? And there's a bidding war, for crying out loud. That sounds crazy.
Mm-hmm.
Okay, well, what we're trying to get back to is a reasonable rate of inflation where, the old rule of thumb, I think, was we just count on our houses to, appreciate 1 or 2% a year in value, right?
Exactly.
Well, it's been way more than that. We did the How Much House Can You Afford episode, and I think in Ohio even, we were looking at like 14%, national average of like 17. I might have those flipped, but still.
It's a big number.
Right, way more than 1 or 2, which is what we're kind of aiming for.
Yeah, and if you have interest rates that are at, 3%, folks can afford a lot of house in comparison to, I think, mortgage rates are hovering around 5 right now on a 30.
I've heard closer to 6 in some cases.
Yeah,
even.
So I mean that's a significant difference.
Yeah, you're going to buy less house.
Right.
Home values should start to the growth of home values should decelerate. Okay?
Or you're going to just not buy.
Right.
You're
or there's less people in the bidding war.
Yeah.
Right?
Exactly.
So there is a practical example of how Fed policy can affect you. Okay. From that standpoint, lending is just not as attractive as it has been for a long time, right?
Right.
Let's kind of go back and talk about now companies. It's less advantageous for companies to borrow money, right?
Mm-hmm.
So what's the impact that Fed rate policy has on the stock market? Because Jason, if you think about it, you go, well, the Fed is thinking about raising rates because the economy is on fire. Stocks have got to be doing really well, right? Companies are doing well. The economy is on fire. Why are they going down when the Fed raises interest rates?
Yeah, well, they also were very overpriced.
Well, and this, we're not going to go there in this, but the return, that a stock returns to its shareholders whenever you can get 1% on your money versus 2% or 3%, right? That will in itself kind of reset prices,
just
right?
pulls them down,
right? How a risk-free return versus going out and investing in a company that does have some risk, right?
Absolutely.
But also the fact that the markets are forward-looking, we always say, right?
Right.
And that's why they're so erratic sometimes.
That's why it's hard to look on a day-to-day basis.
Yeah, they're trying to price in what's going to happen.
Exactly.
That's what the markets do. And when the Fed is hawkish, when they're signaling rate hikes, what a lot of investors are saying is, well, companies are going to be investing less in into their companies and into their product lines and into growing their companies, right? Mm-hmm. Which means that, really what we're looking at, the cost of doing business goes up, right? We're probably looking at lower revenues and earnings, right? And we're looking at that impacting the growth rate of the stock, right?
Yeah, and I think that's a real balancing act.
Yes.
And the stock market's asking itself is the Fed going to go too far?
Mm-hmm.
Are they going to, cause a recession, a true deep recession? And that's why during a period like this, you often have very significant volatility.
Yeah.
Because it's just not happy days are here again.
No.
It just isn't. So
and I think more so now than ever, the markets hang on every word.
Mm-hmm.
And we're recording a podcast here 2 days ago. The Fed met and they signaled they raised 0.75%, right? When the minutes come out and we digest those minutes, the markets react again.
They're going
to
react again. Yep.
So
even after the press conference where they got to ask whatever they wanted.
Absolutely. They're going to look at the wording, and we are so focused on that more than we ever have. how does this, we gotta start moving along here, I guess, looking at the clock, but how does this impact bonds as well? Well, if you think about it, right, bonds are essentially a company owing you money that you lend to them. They're paying you an interest rate, right? And interest rates have been so terribly low, the value of your bond that is returning, let's say 2%, it's not worth as much as a new bond being issued, 6 months from now at 4%, right?
Right.
So when you look at the impact on stocks and bonds, right, interest rate policy has an impact on both of these. And that's why in a year like this year, the old 60-40 portfolio that balanced, each other out, the stocks, when stocks are up, bonds are down, and when bonds are, vice versa, everything's down right now,
right,
because of interest rate policy.
Absolutely.
Right?
Yeah.
So bonds, I use this example with clients all the time. If Blue Jay Financial Group were to issue a bond to add to our building, let's say, right? And I say, we got this great bond. You give us $10,000 and we're going to pay you 2% for the next 10 years. And you go, well, heck, my bank account's paying 0.00001. I'll take it, right? Yeah. And then 2 years from now, advisor XYZ down the road goes, well, interest rates are higher now. We're going to issue a 10-year bond at 4%. And you go, well, I only got $10,000, but I really like that 4% better than the 2% that Blue Jay was giving me, right? Now you got to sell your bond to somebody else to go buy that. Is anybody going to give you your $10,000 back? Because what they're looking at is, why would I give you $10,000 to get 2% when I can just give them $10,000 and get 4%?
Right.
Right? So that's going to affect the value of your bond. So the impact on stocks and bonds really in a rising rate environment is, it's going to put pressure on both.
Right.
Okay.
Absolutely. Yeah. And I think that people don't realize that, that flight to safety kind of mentality during periods of times like this.
If inflation is 9%, cash isn't safe either.
No. And that's a good point.
Really good segue into deposits.
Right. I mean, just putting cash into the bank, also interest rate policy from the Fed impacts how much your savings account is paying. So you're going to start seeing things that are like, hey, I'll give you 2 or 3%, but inflation is 9, guys.
Right. But let's say inflation, let's say the Fed does the right thing. We get inflation under control, but we're in a higher rate environment, right? It's less favorable to lenders, people borrowing money.
Yep.
Now, all of a sudden, it's more favorable to savers and their checking, savings, CDs, right? So again, the Fed is trying to encourage more personal savings, right? Less spending by consumers and corporations. This is how this stuff impacts you, folks. So I would say this, just because the Fed is raising rates, don't expect it in your bank account anytime soon.
Yeah, banks are gonna like try to increase their margin for a little while. So yeah, and don't be too quick to rush into 1.5 or 2% CDs or something like that.
Well, especially with inflation readings where they're at.
Yeah,
so
exactly.
I think that's a really good way to wrap this up. Is how does it affect our portfolios and what we're doing right now? Are stocks and bonds under pressure? Are savings under pressure? Yes. Is the Fed trying to combat that? Yes. So it feels like it's working against us, but where are we going to do better than inflation is doing? Historically, it's the stock market.
Absolutely.
Right? So we're looking for opportunities to reposition, but we are buy and hold. We're long term.
Right.
And we're talking about investments. If you're an investor, you're long term. If you can tune out the noise from the day traders, right? This really affects traders, but really this creates a lot of opportunities in the long run for investors, which we hope you are. And you can all give us a call with questions if you need, right?
You know what?
That's what we're here for.
This high horse has been persistent and transitory.
All right. If you want to know what Jason's talking about, give us a call, shoot us an email. It would be a fun conversation. Thanks for having a drink with us this week, folks. It's time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance podcast, be sure to email us at podcast@bluejfg.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with the latest action by following us on Facebook. Old Fashioned Finance is brought to you by Blue Jay Financial Group. That's bluejfg.com and produced by Podastery Studios. We've been your hosts, Caleb and Jason. Cheers. Blue Jay Financial Group, LLC. Blue Jay is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction unless otherwise permitted by statute. Follow-up or individualized responses to a consumer in a particular state by Blue Jay and the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant an applicable state exemption. All verbal and written consent on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.
Man, I think this drink needs a disclaimer. I'm feeling it. Are you feeling it?
I'm starting to.
I know.
It's a good one.
We didn't drink the whole thing. What the heck?
I'm not a quitter.